Hello everyone and welcome to the NinjaTrader webinar room. Thank you all very much for joining me today. My name is Chris and I work for NinjaTrader at our office in Denver, Colorado. We have a very special event for you today with Dean Rogers of Kase Company. It is important to understand that there are substantial risks in trading commodity futures contracts or foreign currency. You should carefully consider whether such trading is suitable for you, and this will depend on your specific circumstance and financial resources. It is possible to lose all the funds deposited with your broker, and you could even incur losses beyond these amounts. For the full risk disclosure, you can view the link that I am posting into the room now. Also, please remember that these training webinars are not a solicitation nor recommendation, but simply educational in nature. So this presentation is brought to you by NinjaTrader LLC, which is a technology company responsible for developing the NinjaTrader trading platform. Brokerage-related questions should be directed to NinjaTrader Brokerage. And I'll go ahead and post the phone number and email into the room now. And with new tools added nearly every day, NinjaTrader ecosystem is home to hundreds of apps and services. You can quickly and easily find these tools and services you're looking for with a simple keyword search. And you'll find more information about upcoming events and webinars, as well as an on-demand archive to view webinar recordings. So I'll go ahead and post a link to the NinjaTrader ecosystem into the room now. Also, you can follow NinjaTrader on social media, including Twitter and Facebook. And I believe those links were already posted into the room before we started presenting. We are excited for today's unique event with Dean from Kase Company to discuss Kase's approach when choosing an effective bar length using bars and Kase Xrange charts. So once again, thank you everyone for joining us today. And without further ado, it is my pleasure to welcome Dean from Kase Company. Go ahead and take it away, Dean.
Excellent. Thank you very much, Chris. I appreciate the introduction there, and thank you all for attending today. I always enjoy getting together with the NinjaTrader group. It's always great. The NinjaTrader ecosystem is very supportive, such a great community, and I really appreciate working with you all. As Chris said, my name is Dean Rogers. I'm the Senior Analyst for Kase Company. I've been working with Kase for over 19 years now, and so I've got a lot of experience with the Kase tools, with technical analysis. I actually started my career with Kase Company as a programmer, so that's my field of interest is computer programming, so I do a lot of that kind of stuff still. But really when it comes down to it, at the end of the day, I work primarily with our clients, both on the institutional side and the retail side, to help them learn the best ways to use our tools, to help them improve our tools, or to work with them to improve our tools. And that's exactly what I'm looking to do here. So for any of you that are, we just took that poll, any of you that aren't using NinjaTrader, I encourage you to take a trial of it. We've got all of our services and products on there, Kase StatWare, Kase X, and the Xrange bars, which we're going to talk about today. It's a great platform. As a programmer, I really, really appreciate the back-end access that it gives me to do a lot of the things. It gives me a lot of the flexibility for what I want to do with custom bar types and multiple bar lengths and so on and so forth. So it's a very powerful tool, and I encourage you all to take a trial of both NinjaTrader and our software, our services on NinjaTrader. So with that, we'll go ahead and get things going here. Obviously, we just went through NinjaTrader's risk disclosure. We have our own risk disclosure here, our standard disclaimer. There is risk in trading. We all understand that. And that's something we're going to talk a lot about today. Controlling risk is something that's very, very important. It's really, in my opinion, and many traders and analysts and pundits' opinion, that controlling risk is the key to being a successful trader. You can have very effective and great entry and exit signals, but if you do not control the risk in between the entries and exits, in a lot of cases you may be doomed to fail. So with that, let's talk a little bit about, let's get into our agenda here. Oh, there we go, sorry. All right, so like I said, I've been doing this since May of 2000, so over 19 years now. And during that time, one of my key roles has been to work and train clients both on the institutional and retail side. In those 19 years, I have trained and worked with and taught and discussed trading styles and all kinds of different stuff, different techniques, different risk appetites, different approaches to the market, different types of markets, whether they be commodities, equities, whatever, foreign exchange, whatever it might be, fixed income. And I have worked with hundreds, albeit maybe even a few thousand traders during that time. And the number one question, the number one real question that I get is what time frame works best. And this is primarily geared towards our Kase StatWare or our Kase X trading indicators. So whenever somebody takes a trial, and this is both on the retail and the institutional side, most of the time people want to know what time frame works best or what bar length works best. You know, is it a 5-minute chart? Is it a 15-minute chart? Is a 35-cent case bar? You know, 15-minute X-range bar? What is it? And unfortunately, there is no straightforward answer to that, because what we're going to talk about today is there really is no correct or best bar length. And that's not just with Kase StatWare, that's with trading in general. The bar length that you use is very much dependent upon your trading style, and most importantly, in my opinion, your risk appetite. How much are you willing to risk? And so that is a key factor in what I teach traders in how to be successful, not only using the Kase indicators, but any set of indicators. Because the bar length that you choose is very much going to dictate the risk that you have to take or the position size that you'll be able to build. Any good market, any good tradable security is going to be fractal in nature. I mean, yeah, there's some penny stocks out there that just kind of jump around or whatever else, but if you're trading something like the E-mini or crude oil or Apple or Google or whatever it is, there's so much information, there's so much data that's being poured into those charts that we see a chaotic data series emerge, and in those chaotic data series, we see fractal patterns emerge. And so, you know, a lot of us talk about, technicians will talk about 3-wave patterns and 5-wave patterns, and all that has to do with the fractal nature of the market. So the idea behind that is, you know, there's no one time frame that gives you the best patterns. You know, a 5-minute chart has the same types of patterns that a daily chart has. It's just on a much quicker scale. So it's not necessarily that the 5-minute chart is better. It's just you have to be a lot more active on the 5-minute chart than you do on the daily chart. And this is one of the most important points, this next point. A good system or strategy should really be robust enough to work on different time frames and or bar lengths. So we have built into kind of our minds that a system, you know, this XYZ system is best works on a 5-minute chart. Well, more than likely, XYZ system has been optimized to work on the 5-minute chart or this, you know, the 10-minute chart or whatever it might be. That doesn't mean that the 5-minute chart is the best chart. That just means that you have a system, a set of rules that based on historical evidence has been optimized to work on a certain bar length. And that certain bar length with those rules and those optimized settings works best. That's not a robust system that I would want to trust in the future. I want to see a system that works or a set of rules that works not only on a 5-minute chart, but I want to see it work on different types of bars. I want to see it work on different bar lengths. I want to see it work on a daily chart, and I want to see it work on a 15-minute chart. Because again, that fractal nature of the market is going to help us, or is going to be reflected in what our system is actually doing. Is our system, are the rules that we're using robust enough to handle the various types of situations that the market's going to throw at us? So again, I'm not looking to optimize on one certain bar length or whatever else. I really want a system and a set of rules that is robust enough to work on just about anything. And that's where curve fitting is very, very dangerous. Anytime you talk to any technical analysis worth their salt, you know, they're going to tell you curve fitting is something that you really, really got to be careful with. Back testing, over optimizing, you've got to be careful. I'm not saying that back testing and optimization aren't good. They have their uses, they're useful tools, but some people overuse them. And that's one of the things where I think sometimes people get it stuck in their mind that, when they're using a system like Kase StatWare or Kase X, that there is going to be a quote-unquote best bar length or best time frame. All right, so I'll step off my soapbox now, and let's talk a little bit about what we're going to go through with the in the webinar here. So the first step in all of this to determining what kind of bar length we want to use, we need to be able to assess risk. And there's lots of different ways to assess risk. I'm going to show you the Kase way of assessing risk. Part of that is looking at our trading style, looking at our risk tolerance, what are we willing to risk per trade, and also our position sizing. And then above and beyond that, once we know those factors and once we know how to measure that risk, then we can get into choosing a bar length. And we'll talk a little bit today, I mean, there's these methods that I'm going to show you apply to any type of chart, whether it's CAGI or Renko or range bars or whatever it might be, but we're going to specifically talk about time bars and then our Kase Xrange bars that are available on NinjaTrader. So let's talk a little bit about assessing risk. So we're going to talk about trading style. We have to know what we're willing to risk. That, in my opinion, is the most important step. Knowing and understanding that the market dictates risk. The market doesn't care how much we're willing to risk or how much we want to avoid loss. It doesn't care. It's going to trade. It's going to go, right? So market dictates how much risk there is and how much risk we should be taking. And then the position size. So when we're assessing a risk, the first thing that we have to ask ourselves is, what is our trading style? And we'll go over some of those different trading styles here in a moment, just to kind of give ourselves some guidelines. But what this really comes down to is, am I somebody that has the time to be a day trader, so to speak, where I'm going to sit, I'm going to trade, let's say a 5-minute chart, and I'm going to take, 20 or 30 trades a day. Can I sit in front of the computer, be glued to the screen all day long during active market hours? If the answer is yes, then great. But there are some of us, and I think I actually saw some names in the room that I recognize that I've worked with before that can't sit in front of the screen all day, and they might have blocks of time that they can trade, and so they might have to have more of an approach that is a day trade, or not day trading, but more of like a swing trading style, where they assess the market in the morning or in the afternoon or whatever it might be, place their trades and hold risk overnight for days or even weeks at a time. So we have to decide, what kind of time frame or how much time do we have to trade, right? How much time can we commit to sitting in front of the charts and sitting in front of the screen? How active can we realistically be? That's a very key. Some of us have full-time jobs aside from our trading careers, and that's fine. But that means that we can't necessarily be somebody that trades a 5-minute chart all the time. And then most importantly, and this is why I have it bolded, how much am I realistically willing to risk? So if I have a $25,000 portfolio, I don't want to risk $25,000 per trade. I don't even really want to, at that point, risk $1,000 per trade. I might only be willing to risk $100 per trade or $200 per trade. And so if I'm only willing to risk that amount, that means there are certain bar lengths that I may not be able to trade. And that's exactly what we're going to get into. So that's why it's a key point. I always joke with clients and say, when I'm looking at the amount of risk that I want to take per trade, it has to be that threshold where if I lose that amount in that day, my wife is still going to let me sleep in the bed that night. Because if she's not going to let me sleep in the bed, if I'm going to have to sleep in the couch or outside with the dogs, then that's too much risk. So that's something we have to ask ourselves. Where is that threshold? What are we willing to risk? And we can still move on. It's not going to be disastrous. And that's our risk threshold. We also have to look at what types of markets do we want to trade. Are we trading equities? Are we trading commodities, foreign exchange? Because there's different things that go along with that as well, as far as position sizing, leverage, and so on. Can we trade various markets? There's some of us, like Ms. Kase talks about this all the time. When she was an oil trader for Chevron back in the 80s, she could only trade certain markets, basically oil, heating oil, crude oil, and she didn't have the luxury of going out and saying, well, I want to trade natural gas today, or I want to trade, the S&P 500, or some equity market or whatever else. She couldn't pick and choose. So if you're in that situation, there are going to be times where you might have to sit on your hands and step away from the market because there is too much risk involved, because the volatility is too high or whatever it may be, or maybe we're in a sideways market. And that comes down to, when is a market untradeable? There are periods of time where it may be in a sideways range, or very, volatility is too high, and you have to take a step back and take a deep breath and wait for good opportunities. And the last point here is using a stop is a must, in our opinion. We have very sophisticated stop systems that we've developed over the years, and that's a large part of what I'm going to be showing you on how to assess risk and how to determine the bar size that is most effective for your trading style and your risk appetite. So trading style, just again, this is kind of some stuff out of recent CMT material that I was looking at, as far as the way that they define the different trading styles. So you have your buy and hold type of investment strategy, which is more kind of like a monthly chart type of situation. Position trading, where you're holding trades for weeks at a time. Swing trading, where you're looking at holding trades overnight, maybe for a couple of days at a time. And then intraday trading, which, as a lot of people put it, takes nerves of steel and you're glued to your screen. So that's kind of the way that we define the different areas or the different trading styles. And this is one of the things that you have to determine for yourself. Now, when we're assessing risk, we have to have a basic measure of volatility. And one of the easiest and most simple measures of volatility that you can plot on a screen in a very simplistic manner is TrueRange. And so TrueRange is basically the maximum distance of trading between two bars. A lot has been published about this. A lot of indicators use TrueRange. Almost all of the case indicators for both StatWare and Kase X use TrueRange. And so TrueRange is something that we use as a basic measure of volatility, and it's going to help us not only determine where to place our stops, but also what bar length we can trade. Now, we actually use something called TrueRange Double, the formula of which is at the bottom of the screen here. So it's basically the maximum distance of trading between 3 bars rather than 2. And the reason we do that is it gives us a little bit of a smoother distribution whenever we're looking at TrueRange. So it's very similar to the Wells Wilder TrueRange. It's just a little bit of a take that Cynthia came up with when she started designing Kase StatWare back in the early 90s, late 80s, early 90s. Now, one of the things that the Kase stops do is they address the variation in volatility, or the variation in the variability in the distributions of volatility. So if we're looking at average TrueRange, a lot of people, at least traditionally, had used multiples of TrueRange. That's the way Wells Wilder talks about it in his book. And so multiples of TrueRange, that's fine. But if we're looking at the average TrueRange and the average is, 10 cents, then if, 1 times 10 cents is going to be 10 cents, 2 times 10 cents is going to be 20 cents, 3 times 10 cents is going to be 30 cents. But that does not account for variability or the skew in the distribution or the bell curve, or the distribution of volatility. So what we do is we use standard deviations so that we're looking at a statistically probable level. So if we're looking at 1, 2, or 3 standard deviations, it's not necessarily the same as a 1, 2, or 3 times standard deviation, or 3 times the average TrueRange. We're looking at, for instance, the 65th, 95th, and 99.9 percentile of the distribution of volatility over a given period of time, in our case, usually the last 30 bars. So that's just a minor point to make on why we use standard deviations when we're looking at the TrueRange rather than multiples of TrueRange. Okay, so this is just really, I should have come to this chart next, but this is showing us kind of that distribution. So if we have 2 different levels, like a 1 standard deviation or 1.2 standard deviation above the mean, that's going to be right around the 65th percentile. So risk adverse traders might use that. And then if we're looking at riding the trend, we might use somewhere around a 3.8 standard deviation. We're accounting for the right-hand skew. So the distribution of volatility is always skewed to the right. We adjust our stops. So if we want to use a 1, a 2, and a 3 standard deviation move, we're usually adjusting by about 10% at each standard deviation level. So 1, 2.2, and 3.6. In this case, we're using 1.2 and 3.8. Nonetheless, the idea here is we have to adjust for the right-hand skew, but also that by using standard deviation, we're using statistically significant levels for our stops, rather than just arbitrary multiples of true range. So this is a chart with our stops on the screen. Okay, and I know right now we're kind of at a slow point, but we're building up to how we want to choose the bar length and how we want to assess the risk. So these are our stops, the DevStops themselves. Let me bring up a little tool here. Give me 1 second. All right, so the DevStops, you should see a red mark on the screen. So here we have our warning line, which is the median of the average or the double average true range, then a 1 standard deviation, a 2.2 standard deviation, and a 3.6 standard deviation move. And so that is going to be our different stop levels above and below the market. And here at the bottom, we have something called the rev amounts indicator. This is an indicator that is included in the Kase StatWare. It's not something I keep up on my screen all the time. It's just when I'm choosing my bar lengths. And this is going to be important for today's discussion because what this shows us is how much risk per unit we're taking at each of the stop levels. So this is a crude oil WTI daily chart taken within the last couple of weeks. At 1 standard deviation, that's $3.59 of risk, $4.53 at Dev 2, and $5.63 at Dev 3. So it tells us how much risk per unit we're taking at each stop level. Now with the Kase X indicator, we also have our stops. They use standard deviations of true range. We only have 2 stop levels in Kase X. And the risk amount, the amount of risk that's being taken, is shown here on the right side of the chart always by these purple numbers. So the level 1 risk is $4.54 for the most recent bar and $6.74 at level 2. Okay, and these are usually around a 1.2 and 3.8 standard deviation move of the double true range over the last 30 bars. So now we know how much we're willing to risk per unit. We know we can use the standard deviations of the double true range over the last 30 bars to tell us how much risk we're trading at each of the stop levels on a particular bar length. But now we need to start to determine the size of our stop and how much we are willing to risk. So this is where we get into, I'm going to move forward a little bit because we're running a little bit short on time here, but I want to really get into the meat and potatoes of all of this. So let's say, for instance, we're trading equities. Okay, one of the ways that we can control risk is by our position size. My apologies, this keeps changing without me touching the screen here. So one of the things that we can look at is controlling risk by position size. So if I am willing to risk $1,000 and I'm trading Apple, our level 1 risk using Kase X is $11.23 on a particular day and $17.81 at level 2. Generally speaking, we want to place our stop at the level 2 for Kase X, or when we look at Kase StatWare, at DevStop 3. So at $17.81 per share, $1,000 divided by 1781 tells us that we can trade around 56 shares. That means that we have to have 56 shares times the underlying price of $202.55, means that we have to have $11,342.80 of capital. So we know that if we are willing to risk $1,000, we can trade 56 shares. Okay. So position sizing is one way. That's simple with equities. But let's talk now about commodities where we're leveraged. So here we're looking at crude oil again. Same example we were just looking at where we have $3.59, which I'm going to turn this off here because it keeps changing. All right. So we have $3.59 of risk at Rev 1, $4.53 at Rev 2, and $5.63 at Rev 3, which is our Dev 3 value. Typically speaking, we're going to place our stop at Dev 3. whenever we get into a trade. Dev2 and Dev1, or Rev2 and Rev1, are going to be used whenever we have warning signals or partial exits or different circumstances that we reach or signals that we see on the Kase StatWare indicator. But when we're measuring what chart we want to look at or what chart we want, bar length we want to trade, we always want to look at the largest amount of risk that we're going to take, which is going to be Rev3. So in this case, on one contract of WTI crude oil, which is $1,000 per contract, that would be $5,630. So we'd have to be willing to risk at least $5,630 per contract to trade a daily chart. So if we have $15,000 of capital risk, so we're willing to risk $15,000. If we lose $15,000 on one trade, we are okay. Okay, so we've got pretty deep pockets in this example, but we're willing to take that risk. So in this situation, $5.63 times 1,000 barrels per contract is $5,630. $15,000 divided by the 5,630 means that there's 2.664 contracts. Means that we can trade 2 contracts with relative confidence that we're not going to lose more than $15,000 on one trade, right? But what if we only are willing to risk $1,000? 1,000 divided by the 5,630 is 0.177. That means we can't trade any contracts. So what that tells us, if we are willing to risk $1,000 and we want to trade a daily chart of crude oil, WTI crude oil, when the Rev3 amount is $5.63, we can't. It's too much risk for us. Even though we want to trade the daily chart, we can't afford the risk. I don't know why this keeps changing, guys. I'm sorry. I don't know. So we cannot risk that amount. So one might say, well, what if you were to drop to a tighter stop, like Dev2 or Dev1? Well, even in this example, $1,000, like at $3.59, that's $3,590. We still wouldn't be able to use Rev1, right? But let's say we were willing to risk $4,000. Well, okay, we couldn't use Rev3, we couldn't use Rev2, but we could use Rev1. But the problem with that is I want you to look at this chart. A 1 standard deviation move is right around the 65th percentile. So that's going to get hit fairly often. So when we look at this chart here, like for instance, if we had gotten short up, let me try to bring up my pointer here again. If we had gotten short in this area and we place a stop at Dev1, well, we hit Dev1 here, we hit Dev1 here, we even hit Dev1 and 2 in this area, but notice that Dev3 is holding. Dev3 is the 99.9 percentile, meaning when we hit that, there's only a 1% chance that the market's, or less than 1% chance that the market's going to continue in our favor within the next 30 bars. So we want to get out if it hits Rev3 or Dev3, but it doesn't do it. But we do hit Dev1 a lot. So the point is, we want to use Dev3 whenever we're trading. If we use Dev2 or Dev1, we're going to get whipsawed a lot more often. So realistically, what we need to do is we need to drop into an intraday chart and trade a lower or smaller bar length in this situation. So that's what we're going to talk about. So when we go to choose a bar length, we have to account for our risk appetite and trading style. And then we're going to look at a time versus Kase Xrange chart example here. Okay. So when we're choosing a bar length, we know that our total risk divided by the number of units equals the target risk per share or unit. I usually will start off with, like, if I'm dropping into an intraday chart, if I could, what I'm trying to do is find the largest bar length that I can trade that does not exceed my risk per unit. Okay, my goal is to find that chart. If that's a daily chart, great. I will trade a daily chart. But generally, if we have to drop into an intraday chart, especially with commodities where we're leveraged, it's a little bit easier with equities like we talked. We can control the position size. But when we're leveraged with equity or commodities, especially if we want to trade multiple units, we generally have to drop into an intraday chart. So I'll start off with like a 60-minute time or Kase Xrange chart and work my way up and down from there. It gives me a starting point. And what we're going to be looking at is with StatWare, we're going to use 3.6 times the ATR, the DTR, the double true range, which is reversal level 3. Or we're going to look at the level 2 stop for the Kase X double-sided stops. All right, so we know that at $1,000, that's what we're willing to risk, divided by 1,000 barrels for WTI crude oil, we can risk $1 per contract. So if we're trading one contract, we can risk $1. So we are going to look for a Rev3 or a Dev3 amount that is no more than $1 of risk on a given chart. So I went through and I worked. I'm not going to go through all the examples just for time's sake here. But I started off on the 60-minute, and that was a little too high. So then I dropped to a 30-minute chart. Let me get rid of this again. So I dropped to a 30-minute chart, and on that 30-minute chart, our most recent value is 94 cents over here on the far right. So this upper blue line is 94 cents. So that's less than $1 of risk. But we can see that the range varies from anywhere from 43 cents all the way back in here. Well, what I'm saying here, you guys need to be able to see what I'm talking about. So all the way back here was 43 cents at Rev 3. It was $1.43 or $1.50 up in this area when we had this gap up. And then it was, even $1.20 right here. So it kind of varies. So we might even really realistically have to drop to something even less than a 30-minute chart to account for some of these volatility spikes. But for the most part, this chart has less than $1 of risk, so I'd be fairly confident using a 30-minute chart for my trading. So again, the idea here is that we want to figure out how much we're willing to risk per unit and then use our measurements. In our case, we're using the standard deviations of the average double true range over the last 30 bars. We're using around a 3.6 standard deviation move, and we're honing in, which is going to be our widest stop, and we're honing in on a bar length that is going to have that as close to that, in this case, $1 risk as possible. Okay, so for a time bar, for WTI within the last couple of weeks, that was right around a 30-minute chart. Now, with a Kase Xrange chart, and I will describe what the Kase Xrange chart is and how it works here in just a moment, that ended up being a 60-minute chart. So on the 60-minute Kase Xrange chart, we actually end up with the majority of all of this. The range of volatility was from 84 cents for Rev 3 to $1.42. So a much tighter range than we saw on the 30-minute chart. And we've effectively doubled our bar length here, which means that we're going to be able to hold our trades longer and through more trends. So again, we want to try to trade the longest bar length possible. And by using an Xrange chart in this situation, we were effectively able to double the size of our bar. And again, I'll explain how the Xrange charts work and everything here in just a moment. But the idea here is that Rev 3 is still sitting right around 94 cents. But we can see, other than this little spike when we had this gap up, the Rev amount stayed below or right around $1, the Rev 3 amount. Okay. So for our $1,000 of risk on a crude oil or WTI chart, we could risk $1 per contract, which means that if we're going to trade one contract, we could either trade a 30-minute time bar chart or a 60-minute Kase Xrange chart. Now you might ask how often you have to evaluate this. And that's a great question. With the time bars, because there is a wider distribution of the volatility or of the Rev 3 value, you're going to have to look at that more often. I would look at that probably once a week. With the Xrange chart, because it's a smoother distribution of volatility, you're going to have to look at that less often, at minimum, or at most, excuse me, once a week, but really realistically, you could probably even go every 2 to 3 weeks, maybe even a month, with reassessing your bar lengths and what bar length is most effective. Okay, and you just use this measure, the same measure. Now let's talk for a moment about the Xrange bars and what they're actually doing. So the Xrange bars are high-low range bars, so very much like the range bars that are built into NinjaTrader. The biggest difference is that we are using an underlying time bar length to determine a dynamic target range. So with a range bar chart, I might say, let's say again, we're talking WTI, I might want to use a 35-cent high-low range, meaning that each of the bars on the chart is going to have a high-low range of around 35 cents. Some range bars, it'll be exactly 35 cents because they'll put in ghost data or whatever else. We don't do any of that. We don't put any fake data in. We don't do any of that kind of stuff. We just use real tick data to build the bars. But what we will do is we'll say, in that example, we were saying a 60-minute Xrange chart. So what it's doing is it's looking at a 60-minute bar in the background. We build a 60-minute bar. We're looking at what the average high-low range of the 60-minute bar was over the last 10 days. And then we're setting for that day the target range for the range bar to that amount. So today that amount might have been 15 cents. And tomorrow that might be 16 cents. And the next day it might be 17 cents. But each day we're reassessing what the average high-low range of a 60-minute chart is and using that as the target range for that day. So it is a range bar that dynamically adjusts to the volatility based upon an underlying bar length. It makes it really simple, and this is one of the reasons that we created the Xrange bars in the way that we did. Was we have another bar type called case bars, and a lot of people wanted to know, well, how do I determine, like if I normally trade a 15-minute chart, well, what's the best, length for a 15-minute chart on, Apple for a case bar? And, the answer was, well, you got to put up a 15-minute chart, look at the average true range over a given period of time, and then use that as the range. So when we created the Xrange bars, we wanted it to do all of that automatically for users. So the Xrange bars just give us a much smoother distribution of volatility. They make your indicators work much better in most instances. You will get earlier signals. You will get signals, entries and exits earlier and more often. So for instance, here we have a 3-minute Xrange chart on top and a 3-minute time bar on bottom. And you can see that during periods of consolidation, there's not a good period of consolidation here, but like overnight, so let's say on commodities, overnight, when the market's not real active and you get a lot of sideways range bound trading, that will all get kind of smushed up into 1 or 2 bars on the Xrange bars. Whereas when you have a breakout move like these, especially like this one, you can see very clearly it breaks that 1 bar up into a number of bars. So if I'm feeding this signal, like let's say normally we feed closes like into a moving average, let's say. I'm feeding in this 3-minute period of time, I'm feeding 1 closing price that moved from here to here, right? Whereas on the Xrange chart, I'm feeding in all of these closes during that period of time. So my indicator can more smoothly and quickly adjust to the change in volatility, and therefore will most likely give me a signal on my indicator sooner. So the Xrange charts are extremely effective, very much like range charts are. Okay. And then one last example here. Again, the distribution of the volatility is much smoother using the Xrange charts. Here we have the Xrange chart on the top. This is a 30-minute, and then we have the time bar on the bottom. Here's a good example where we kind of have that overnight sideways trading on the 30-minute chart. All of that gets consolidated into just a few bars on the Xrange. But then when we have these big breakout moves, we break that up into a bunch of smaller bars. So much more effective. And this isn't just for the Kase StatWare or Kase X indicators. You can use this with any of your charting or any of your indicators. Whether it's moving averages, RSIs, oscillators, whatever it may be, I have found that they make just about every indicator much more effective. And we can also see here, I know, it's a little hard to kind of discern this, but this is the distribution. This is the average true range. And so the average true range varies much less for the X range chart than it does for the time bar chart. And again, that tells us, like, when we're using this to pick bar lengths, if we're using time bars, we're going to have to change those bar lengths much more often. All right. All right. So we are right at the end here. I will go ahead and start taking questions. So you can start typing in questions that you have. One of the things that I wanted to point out is, if you are interested, I know I didn't go through a lot of our Kase StatWare or Kase X signals. We really just talked about our stops and how to use those to assess risk today. But if you are interested in taking a trial of the X range charts and our Kase StatWare or Kase X indicators, you can do so by going to this website here, caseco.com/ntwebinar2019. And that will take you to a web page. On that web page, I will post the recording of the presentation along with the recording that the NinjaTrader ecosystem posts. I will also put a PDF of today's presentation. That's already up there. You can actually take the demo there, and you can also subscribe. Now, one of the things that we're also doing today is we're offering a webinar discount special. This will actually be active for at least the next month during the 30-day trial, so into early August. If you decide to subscribe to Kase StatWare and or Kase X, it will be at a discounted rate, 13 months for $18.95. That's about a 25% discount over our normal month-to-month rate of $195, as well as our yearly rate of $19.95 per year. Okay. All right, so let's see. Let me answer any questions here. X-range bars are only based upon underlying time bars. What about volume? They aren't based upon volume bars at this point. That's actually pretty interesting. That might be something we could look at in the future. That's not something I've thought about. So yeah, right now, Steve, we just use an underlying time bar. We don't use a volume bar to do that. Kind of our method is, time bars are kind of at the bottom. Volume bars would be above that. For a long time, we used volume-based bars, and then once we were able to start building our own range bars, like Kase bars and the X-range bars, then we moved to those. But that's a great question. I'm going to actually think about that and think about a way to maybe do that. That might be an effective way to do things. All right. Do we have any other questions? And I apologize if you guys hear my dog barking in the background. It's almost time for dinner for him. Okay. Well, I know that this was a very simple topic today, but I really hope that it will help you. So how long does a 1x range bar last? So Gene's asking how long? Well, there's no, so let's say we're using, I don't know what you mean by 1x, but let's say we're using a 15-minute range bar or Kase X range bar. It's not necessarily 15 minutes. There's no time value. It could take 3 days to fill out that bar. It's just, so let's say if it's a 15-minute range bar or a 15-minute X range bar. Let's say that the size of that bar is 30 points. If it takes 45 minutes to exceed that 30 points, that's how long it's going to take. So there's no time value. We're completely removing the time element from the bar when we're using the X-range charts. The bars are based purely upon price movement, not time. And when it comes down to it, outside of options trading, price movement, not time, is what makes you money. So Richard's asking, how does the 30-day trial work? So basically with the 30-day trial, what you'll do is you'll go to that website that I gave there, caseco.com/ntwebinar2019. You'll fill in a form. That form will automatically send you the Ninja script. If you have not taken a trial of StatWare or Kase X before, when you install that Ninja script, your 30-day trial will automatically be activated the moment you install or import that script, and we send the instructions for doing that. If you have taken a trial before, you will have to reach out to us. It will tell you, that your trial is up, your trial period when you try to put the indicator on the chart. Just contact us. We'll work with you, and if you're still eligible for a trial, then we will go ahead and reset your trial so that you can get in there and use it. So Gene, you said you're talking about, let's see. So you said, like, for instance, NQ has a 70-point range from 4 to 415. How does the Xrange bar help manage that type of move? Well, it depends upon the size of the Xrange bar. So if your Xrange bar is set, let's say it's a 15-minute Xrange bar, and the average range of a 15-minute chart over the last 10 days has been 7 points. Well, during that period of time, during that 70-point move, you're going to get 10 bars that form. I hope that answers your question. I think that was kind of a combination between Gene and Nancy. Yeah. Okay. Okay. Any other questions? Well, again, I appreciate all of you, the NinjaTrader. I appreciate NinjaTrader giving us the opportunity. We are always very thankful for that, to be able to get in front of the NinjaTrader ecosystem community. Such a great community to work with, and so we do appreciate that opportunity. And again, I'm happy to help all of you in any way that I can, so please feel free to take a trial, shoot me an email if you have questions about today's presentation. You can download that presentation from that web or that URL that I gave here on this chart or on this slide. And if you have any questions, feel free to shoot me an email or give me a call. I will be around. All right. Jeff, thank you very much. All of you have a great day, and I think we will stop there.
Perfect. I personally would like to give a special thank you to Dean Rogers of Kase & Company for a great presentation. Everyone in attendance here today will receive an on-demand recording of today's event, so please keep an eye open for that email. NinjaTrader Ecosystem is pleased to sponsor these weekly vendor events as a value-added service for our clients. If you find value in these events, we hope you will attend them on a regular basis. We would like to remind you the information provided in this was of Kase & Company and not of NinjaTraders. All information was for educational purposes and should not be construed as trading advice. Again, we appreciate the time you spent with us. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us at NinjaTrader Ecosystem. And again, thank you so much, Dean.